So the markets are on fire, and if you're sitting on a concentrated stock position with big embedded gains, you've got a tough decision to make. First, you could sell and pay taxes, or secondly, you could hold and live with the risk. But what if there were better options? Today, we're going to break down three powerful tax efficient strategies to help investors diversify without immediately triggering capital gains. Now, each tool has its own trade offs, liquidity constraints, cost, and complexity. So, investors really need to pay attention if they want to diversify their portfolios and see which of these three options could suit their needs best. To go over this today, I have with me Wes Gray, CEO and CIO here at Alpha Architect, and Jack Vogel, co-CIO. Jack, let's start off with one topic we've already talked about in this channel, and that is 351 exchanges. So what are 351 exchanges and who are they for?
Yeah, so Section 351 of the tax code allows investors to contribute appreciated assets or property in exchange for shares of a newly formed corporation without triggering a sale, which for certain assets could possibly trigger capital gain taxes. So this sounds pretty good, right? But there's a catch, which is that in order to participate in a 351 exchange, investors must contribute a diversified portfolio of securities. And so while there are some nuances related to this exchange that investors need to be aware of and dig into, the two main portfolio diversification requirements are as follows. First is the 25% rule, which is that no single security can be more than 25% of the portfolio that is contributed from the individual and household. The other is the 50% rule, which is that the weight of the top 5 positions cannot exceed 50% of the portfolio's value. So if you have a concentrated position that's very large, such as like a single stock position, Section 351 may not work unless you bring additional diversified assets to the contribution exchange.
This sounds like it's great for investors with moderate concentration, but not full-on concentration where they only have one huge stock position. Does that sound right?
Exactly. Yep.
All right. So let's shift gears then and find a solution for investors with single stock positions. So this is going to be a fun one. Wes, what's a solution to this problem?
Well, so one solution to this problem, which has been around for over 50 years now, is what they call an exchange fund. Not to be confused with an exchange traded fund like an ETF. This is an exchange fund, which is basically structured as a limited partnership or a hedge fund structure. And in those vehicles, you can contribute concentrated positions to these new exchange funds. However, those come with a 7-year lockup. So you can contribute your individual Tesla or an NVIDIA or whatever the heck it is, and that's fine. You won't have a tax hit, but in order, you have to hold it for 7 years, because if you pull the assets out before that, you do have a tax hit. So that's the big downside. You can contribute the concentrated stock, but now you have a 7-year lockup, not to mention all the complexities and fees and other things associated with limited partnership vehicles.
Wes, would you say that this is a good solution for concentrated investors who are okay with illiquidity in exchange for tax deferral and diversification?
Exactly. It's one of the only solutions. So whether it's good, bad, or in between, if you have a concentrated stock position and you want to diversify, this is one of the only games in town. And you're going to have to take the liquidity, take the fees, take all the other costs, is what it is.
Yeah, so let's throw a curveball here, because what if we have an investor who needs liquidity? Jack, is there another potential solution for this one?
Yeah, so there is another active strategy where you form a long-short portfolio and use the short positions to harvest tax losses while then gradually unwinding the concentrated stock position that most likely has a large embedded capital gain. So here's how it works. First, you're going to short correlated securities or indices to hedge your exposure. The second is you'd probably actively manage the portfolio to realize losses on the short side of the portfolio. And then third, you would use these losses to offset gains as you sell some of the concentrated position over time. Now, again, this is just an example, And investors need to be aware of the pros and cons of doing this. So some of the pros of this approach is, number one, unlike exchange funds, there's no lockup periods. Another pro is it can work alongside other strategies. And the third, obviously, is you can use some of the losses from the short side to possibly offset gains. So it could improve your after-tax outcome. Now, some of the cons are this is going to require careful execution and monitoring, right? So most likely, I wouldn't recommend trying this on your own. It really works the best in volatile markets, so you might need that for it to work the best. And then the third is it doesn't really fully eliminate the concentrated stock risk itself. It's just a way to manage the tax impact of gradual selling. So not perfect. There's some cons with the strategy.
So this sounds like it's good for someone who wants to gradually exit a position, but it's not immediate, right?
Yeah, it's not immediate and it's flexible, so you can use it with other strategies.
Great. Thanks, Jack. So for viewers at home, here's a quick table we made summarizing these points. If you want to go into more detail about the differences between 351s, exchange funds, and long-short tax loss harvesting strategies, make sure to check out the blog version of this video, and I'll leave that link in the description. Just to reiterate, each of these strategies have their own trade-offs, complexities, and it's super, super important to consult with tax, legal, and financial experts before making any moves. Now, if you found this helpful, don't forget to like, subscribe, and hit the notification bell for more insights on tax-efficient investing. As always, you can go to alphaarchitect.com for more educational resources like this one. I want to thank you for watching, and we'll see you next time.